information, so that we have the spelling of their name correctly, that the social security number is in there correctly, as well as their date of birth and address. That can cause an issue for us if we find down the line that any of that information is incorrect, because when it gets to underwriting, they'll let us know. And, you know, in some cases, we have to re-pull credit, which we never really want to do in the middle of the loan process. The second part to the application is employment. So there we're looking at employment history. We do want to ensure that we have a 2-year employment history. The other thing that we're looking at as far as employment history is concerned is how many jobs they've had within those 2 years. So for instance, our FHA loan program doesn't really allow for more than 3 jobs in a 12-month period. If we do find that they've had over 3 years, then we have to take additional steps to verify and document the stability of the borrower's employment. So we're looking at those things for employment. Next would be the income. Income, we're looking at the type of income that they're receiving. So are they receiving W-2 income? Are they maybe contract work or receiving 1099s, things like that? Because we do treat income differently based off of the type it is. So if they're self-employed, then we have to look at a 2-year average. If they are W-2 earners, if they're on salary, well, we look at the salary. And if they're hourly, then we would have to determine what their hourly wages are, and if they are, you know, meeting what they should be with their year-to-date totals. Also with income, we're looking at stability in their income. So have there been any gaps in employment at all? If so, we would need to determine, you know, the reason for that gap. Also, we're looking at the trend of income. So has their income been, you know, more or less the same? Has it been increasing, or are we seeing a decrease? If we're seeing a decrease, then that's something that we're going to need to take a look at a little bit further. Lastly, we do also look at assets. So we would be looking at the sourcing of the funds for closing. So we would want to make sure that we have enough funds to cover the closing costs. Okay, so this is the initial application. This is what the borrowers are inputting. At this point, we haven't been able to verify anything. We're just running the credit. And we're using the information that they've had, that they've provided so far. Okay, so that's application. Any questions there? Okay, so let's jump into pre-qualification versus a pre-approval. So it's important for you guys to know the difference, because with the pre-qual, basically all it is the information that they've provided to us. You know, either they provided it verbally or they've input the information through our app on their own, and then we've been able to pull credit. So looking at the credit score is one of the things that we look at for pre-qual. That'll let us know if we're able to move forward, just dependent upon their credit score. Then you're looking at debt ratios. Is it not showing? Okay, one moment. Here. Can you guys see my screen, or?
Yes.
Is it, or is it? Okay. Or is it showing the whole?
It's showing
The next slide. Okay, let me see if I can fix it. It's not showing like that. Sorry, guys.
It's showing well. It's just that it has, your presentation shows, you know, how it gives you the option of looking at your next slide, and we can see the next slide, but it's no big deal.
Okay. Okay. No.
So it's set up on the instructor. It's called the instructor view or presenter view.
Okay. I'm not sure how to change it. so-
That's in the actual slide deck itself. It's at the upper right-hand side. That's where it's at, but that's in the actual, you've already got the slideshow going, so.
Yeah. Okay, it's fine. So I went over application. Okay, so for pre-qualification versus pre-approval, we're looking at the credit score. So that's going to let us know, right then and there, how we look as far as credit is concerned. If we need to maybe look at rescoring to bring the credit up, or if credit is, sufficient to go ahead and move forward. Also, we'll be able to determine the debt ratios. Now that is just based off of the information that they've provided. And then as well as the budgets and estimates. So more or less, what will their budget be? And then what will their estimated payments be? And then we'll basically know or have a general idea of whether or not we have the green light or the red light. And even if, credit is showing that it's not sufficient to move forward at this time, like I said, we can always rescore and see if we can get the credit up higher. So for pre-approval, there we've been able to verify the data. So at this point, we would have received all of the documents to ensure that the information that they've input into the application is correct. So we would have asked for a copy of their ID and social security card, which is important because like I said, we want to make sure that when we pull credit, we have the correct information in there and can take care of that before it gets in any changes, that is, before it gets into underwriting. Also, we're looking at their most recent 30-day pay stubs. So for that, that's just going to give us an idea of, what the income is that they're receiving. Are they hourly or salary, and how much income we can use for pre-approval purposes. Then next, we're looking at the last 2 years of their W-2 form. So if they are W-2 earners, we just want to make sure that that's matching up to what, their reported income should be. If they are contract workers, then, we'll also need their 1099s over the last 2 years. And then if self-employed, we're looking at the tax returns for the last 2 years. And again, we're just looking at, stability and trend in income for these things as well.
I have a question.
Okay.
So if there's someone like a salon owner or a nail tech that doesn't, it's a 1099 is what they use.
Mm-hmm.
How do you track that? Like, is that something that's, so let me give you an example. So I had a nail tech and she didn't qualify because she claimed everything, like her polishes and her all her products that she uses. She
Right.
claimed all that, and so it looked like if she made 50,000, it looked like she made 10. But is there
Okay.
a way that you can, as a lender, can look at that where she doesn't have to pay a lot of taxes and still claim all her items?
Yeah, so when it does come to our self-employed borrowers, there's a couple of things. First, we want to make sure that they have a 2-year history of self-employment because we do take an average. So we do find that, yes, they do have a 2-year history, but they do report quite a bit of deductions, which is bringing their overall income a lot lower than what they're actually making. We do have to go based off of that net income. And so that can, cause them to be approved for a little bit less. So those are some things that we do have to look at with our self-employed borrowers just to determine, whether or not they're going to be able to get approved for the amount that they would like to get approved for. But I mean, we can look at their income. There are certain deductions that they make that we can add back, such as depreciation. So I mean, that's helpful. But if they're deducting, quite a bit, then yeah, that can be harmful for approval.
If I can chime in real quick, sometimes it's a little bit too harsh to, analyze a self-employed borrower, as you said, right? Well, they wrote off a lot of expenses and their net income seems to be a lot less, but really they made a lot more. And you can see it maybe on their bank statements or, their financial practices, whatever. But at the end of the day, the only analysis that we have as lenders for a self-employed borrower is their tax returns, because that's the official document that tells us what amount of income they made in their business. However, the borrower or the individual goes in and expenses out, right? They don't want to, they made $100,000, yet they had to buy equipment, they had to buy, materials, pay labor, etc. They want to deduct that, so they're not taxed on the amount of the gross income. We want to be taxed on the net income, what we kept in our pocket. So it's a double-edged sword, because if they want to go and file a lot of expenses to avoid taxing, then when it comes to financing, that will be detrimental to the borrower, because at the end of the day, they're saying, well, I made 100,000, but I had $90,000 in expenses, and my net income, what I kept in my pocket at the end of the year, was $10,000. Then it's completely impossible for any lending institution to trust you that you will have the capacity to pay back a loan, right? Whatever it is, $100,000, $200,000. So that's how you have to, or we have to analyze a scenario of a self-employed borrower. Now, there is an alternative for these borrowers that have the challenge that they filed their taxes, they've written off a lot of expenses. If they're able to provide bank statements and we can see a large amount of deposits, we have loan programs that are non-QM, not a Fannie Mae, not a Freddie Mac. So these loans have a larger down payment and usually, and not usually, but always a higher interest rate. So somebody in a situation like that always has that alternative. Self-employed borrowers, they can provide us 12 months bank statements. We look at the average amount of deposits on a monthly basis and go back 12 months to see what their practice, what their trend of deposit is on a monthly basis. And we can do a calculation based off of that number, which is, like I said, is not your typical, is not the conforming way of doing a loan. So that's what they're called alternative financing. So they may have the option of doing that, but it's kind of like, we always go through this explanation with borrowers. Okay, do you want to save yourself whatever amount of dollars by filing all these expenses and having $10,000 of net income? Because if you go and finance, instead of getting a 4%, you're going to end up getting a 6% interest rate with with more money down, etc. So anyhow, just wanted to give you guys that alternative, because it does become available from time to time for borrowers that are in that predicament.
This is Nina in Corpus. Can you hear me?
Yes.
So to that point, you would and that for 2 years they show their, show that they make more money, or to your point of the bank statement, refinance do they have to wait a certain amount of time before they just do a better interest rate?
Yeah, these loans usually come with a prepayment penalty. They can be 5, 3, or no prepay. The lower the prepayment penalty period is, the higher the interest rate is, because these lenders are private investors, so they want to make sure that they have the loan open enough of time to be able to recuperate their investment. So, like I said, they come with a 5-year, 3-year, or no prepay penalty. And the prepayment penalty is 6 months of interest at the time of payoff if it's before that period of time.
And when you say higher interest, about maybe.
I'm sorry, you cut off a little bit, but I think you asked for just the interest rate.
Yes, more or less.
It'll be in the range of, I would say, between a 6 to a 7.8.
That's not horrible.
No, not at all. For someone that cannot acquire housing because of financials, this is definitely a good alternative. And it's like I say, like you want to put 2 and 2 together and do an apples to apples comparisons for the borrower and say, okay, do you want to wait in maybe one more fiscal year to file your taxes, file X amount, and this means that you will pay X amount in tax dollar, or do you want to purchase now and have this interest rate, which means that you will be paying X amount dollars more than if you had a conforming loan, versus 7 versus a 4% interest rate. But that's always an alternative to use for your self-employed borrowers.
Perfect. Thank you.
You're very welcome. And there are programs, they're getting a little bit more and more creative, more aggressive with these programs. There's a 24-month program, a 12-month program, and there's now a 3-month program. So that's an option as well.
Thanks, Oz. Lastly, we are asking for the most recent bank statements up to 2 months. And again, this is just to determine that they do have the funds in the bank for closing and that we're able to source those funds. So we definitely don't want to use that mattress money. We want to make sure that we have the funds in the bank for closing or an allowable source, such as their 401k, if they're going to be using that. So for our loan programs, just a quick snapshot, we do have the conventional FHA, VA, and USDA. And to go into deeper detail, for conventional, this is credit and debt ratio driven. So the better your credit score, the more likely you are to get qualified. And then you are looking at having lower debt ratio, debt to income ratios. For credit score, we do have a minimum of 620. However, it does depend on the overall loan profile. So, I mean, at this point, we do see a lot of times that we need to have a 660, maybe 680 to get approval, just depending on the overall loan profile. If there's collections on their credit report or late payments, that does affect approval. So it just depends. Excuse me. For down payment for our first-time home buyers, they can get the 3% down payment option. First-time home buyer is going to be anyone that hasn't owned a home for at least 3 years. For those that have owned a home for 3 years, then we're looking at a 5% option for down payment. Now, your total debt ratio cannot exceed 50%. So it is a little bit more difficult to qualify for the conventional loan program as it would be for the FHA. Your mortgage insurance is waived if you have a loan to value of 80%. So if our borrower is putting 20% of the down payment, then they would not have to pay their monthly mortgage insurance. So that is helpful in bringing their payment down. The mortgage insurance is variable in that once they do pay down their loan to value once their loan to value does come to 80%, they can request that their mortgage insurance be dropped. Once it hits 78%, then it is usually automatically dropped. For the conventional loan program, there is no upfront mortgage insurance premium. So they're not being charged a premium within their loan amount. Their loan amount will be what it is supposed to be after the down payment is taken out. Overall, this is the best long-term loan option because it is saving the borrower money over the life of the loan. With seller concessions, they are allowed. Typically, you're seeing 3% of seller concessions. However, they can get up to 6% if the loan to value is anywhere between 75 and 90%. So if typically we are seeing that, our borrowers are coming in with either the 3 or 5% down payment. So there you're looking at your seller concession of up to 3%. Any questions on that? Okay, so for FHA, this is a more flexible loan option. So our credit here is as low as 580. With down payment, you are looking at a 3.5%. So, for those that had previously owned a home before, it is a little bit lower than the 5% that they would have to pay. The total debt ratio here is not to exceed 57%. So you can see here, it's more flexible in the amount of money that we would be able to lend them or that they would be able to qualify for. Now with FHA, you do have an upfront mortgage insurance. So it is at 1.85%. What's going to happen is that's going to be a percentage of the loan amount, and that will go into their overall loan amount. So let's just say we're at 100,000. You'll add another 1,850 to that for their overall total loan amount. You have your monthly mortgage insurance as well. Unlike the conventional loan program, this one will be fixed for the entire loan term. And the mortgage insurance basically is just an insurance that is used to protect the lender in case of any default. With FHA, you can see lower rates. So that's helpful as well. And then you do have the 6% seller concessions max. Any questions on FHA? For VA, our borrowers do have to be eligible. So we do request the documentation that would show us their certificate of eligibility, DD 214, that lets us know what they're going to be eligible for. They do have to have a credit score of at least 600. With the VA loan, they will not have monthly mortgage insurance, which is helpful. However, they do have a funding fee of 2.33. This is for the first use, or a 3.6 for subsequent use thereafter. Now, the funding fee basically is the same as your upfront mortgage insurance fee, where it is added into the overall loan amount. So it's nothing that they're going to have to pay up front or anything like that. With VA, it's strong credit, high debt ratio. So with VA, we really don't have a max debt to income ratio that we need to be under. It can go a lot higher than our loan programs, but there's other things that we would look at in factoring out approval for our VA loans. You're not going to have any down payment for a VA loan. So of course, that's attractive to the buyer, and they can get up to 4% seller concessions. We have our USDA loan program. Here again, you can get the 100% financing. You do have to make sure that the property is eligible for a USDA loan. Typically, it's going to be in your rural areas, but we would need to get the address of the property and determine whether or not it meets the eligibility criteria. They do have to meet income requirements as well. For USDA, I believe they have to be under 90,300 for a family up to 4. And then thereafter, I think it's 115 from 5 to 8. You have a low mortgage insurance. So with USDA, it's a little bit different. They have the low MI. So it's actually an annual fee that is written into the loan each month, kind of like a mortgage insurance. And then they have a guarantee fee, which acts as, that funding fee in VA. So the guarantee fee is going to be up to 1% of the loan amount, and that annual fee is at 0.35%. So it is low. Both fees are low. So USDA is also a very attractive loan program. With USDA, you can receive 4% seller concessions. And the rates for USDA are low as well. Any questions over any of the loan programs?
Can you put up the conventional, please?
Yeah. Did you have any questions or just want to write something down?
No, thank you. I appreciate it.
No problem. Are you good to go? Okay.
Thank you.
You're welcome. All righty. Lastly, we'll look at our down payment assistance programs. So we do have the TDHCA and TSHAC down payment assistance programs. Here you do have to meet eligibility, excuse me, eligibility criteria to be able to use any of these programs. So there is a minimum credit requirement of at least 620. They do have to meet income eligibility requirements as well. And you're looking again at about 90,000 or needing to be under 90,000. For TSHAC, for THCA, they're needing to be under 75,000. For the, there's also the industry eligibility. So I mean, if we're looking at the Homes for Texas Heroes, then they'll either fall into one of the categories of nursing, teaching, firefighter, police officer, or correctional officer. And so we can use those own programs for them, but then we also have an alternate option, which is the Home Sweet Texas, which is used for our low to moderate income earning families. So they don't necessarily have to be, a teacher or correctional officer. They can still be able to get approved for the down payment assistance as long as they meet all the other requirements. They don't have to be a first-time home buyer, but this does have to be their primary residence. And then lastly, for down payment assistance, there are some marketing forms on their website in which you would be able to input your information if you'd like to provide, your clients with this information directly. Any questions about the down payment assistance? It is super, it's a great program. It's super helpful for those that either, don't have the funds for closing, or maybe they do have the funds, but they, don't want to use all of their money for closing. Maybe they want to save a little bit to furnish the home or whatnot, or just have money saved. There are different options with the down payment assistance program. So they can choose to receive either a 3%, 4%, or 5% of assistance. So different levels of assistance. Now, based off of the level of assistance that they choose, their interest rate changes. So as far as the interest rate is concerned, we would have no control over the rate. It is provided to them based off of the program that they choose and the level of assistance that they're going with. The rates do change daily, and it does depend on which day we end up locking. So it does go up. So if you go with the 3% of down payment assistance, you're going to have a lower interest rate. 4%, you'll be going up just a bit, and 5%, you'll be going up even more than that. But it is helpful for those that are in need. Lastly, our Mortgage Pros way basically is, we're relational. We understand what you guys are going through. We want to work with you guys to help you grow your business. We want to grow with you. We are looking to establish long-term business relationships. So, we're not transactional. We're looking for those actual relationships. We want to make sure that we help you in any way possible, to grow your business and to get your name out there. We're here to support you guys in any way. You just give us a call anytime. If you have any questions about anything, we're always available to support. We do use the common sense approach, so we're not going to make things harder than they need to be. If there's a will, there's a way, and we'll make it happen. We do come with knowledge and experience. So I believe, Oz, correct me if I'm wrong, but you're over 20 years of experience, or right at. And then we have, our branch managers as well that have several years of experience. So, if I don't have the question or the answer to your question, I definitely can get with, any of our branch managers or Oz to get the question answered. We do have an company team underwriter that's in-house. So that's helpful in that if we do have any questions that, we need answers to, we can go to her just to kind of determine, is this a situation that we can move forward on, or what would we need to move forward? It's very helpful to have that before you even go into the process. And then lastly, we do offer resources and technology. So, we have our Mortgage Pros app that we can provide to you guys, a link to the app. We can set it up to be co-branded. So if you guys, wanted to share the link, you could share it. And then it's super helpful to the clients because they can apply directly through the app. They can upload all of their documents through the app. There's a scanner embedded, which makes things a lot easier because not everyone has an access to a scanner, but they would with our app at their fingertips. And then I think the thing that my clients love the most is the mortgage calculator that we have. So a lot of clients just think that you have to pay principal and interest, but they're not thinking of the homeowner's insurance, mortgage insurance, and the property taxes that are also included in the payment. So it's a reality check because we already have those things preset in our app. So whenever they are running numbers, they are going to be the numbers that we would be running ourselves. So it's super helpful. Any resources that you guys would need, just let us know. And we'd be willing to team up with you and co-brand materials and things like that. So, at the end of the day, we're here for you guys. We have 2 offices, one in McAllen, one here in Mission, and we have several loan officers that can help you guys. So, like I said, if you need anything, just let us know. If you'd like to put your name and number in the chat, please do, and we can reach out to you if you'd like to get a little bit more in-depth knowledge about something in particular.
If I may add something real quick, I don't want to take much time, but I would actually, don't leave it as an option. I would like you to put your name and number on the chat. I believe that I've been in this industry for 21 years now, as Brittany mentioned it, and I think that one of the most important things for your success in this business, for you to create a solid career and a solid business out of real estate, you have to compile together a team of professionals that you can fully rely on. And that is why I believe that in order for any real estate agent to be successful in this industry, they have to have a very solid relationship with a mortgage lender. I always suggest new lenders, new loan officers, and new real estate agents to, come together, sit down, look at each other's business, see how you can be of value and support to each other. So I strongly suggest that, whether it is Brittany, it is one of our mortgage pros, or someone that, you're just more comfortable working with, or maybe you have done transactions with, take advantage of that. Give that portion of your business the importance it needs. It's something that's going to elevate your business. It's going to elevate your experience and your customer experience, more importantly, as you're working with people that are reliable, that are going to give you answers. As a real estate agent, your most important aspect of business is to sell. But a really important part of selling is majority of your buyers will have to have a lending experience. So you want someone that you can call on a consistent basis about questions that have to do with the ability of one of your buyers to close on their transactions. And you want someone that is so trustworthy to the point that they understand that it's not just about the business and the clients that you two have together. It's an entire business, right? It's an entire business approach where it doesn't matter if you have a loan with Navy, Army, Federal Credit Union, have one of your borrowers that is working with Wells Fargo. You want someone that can answer questions for you if the event that you don't have that access to communication with these lenders, which is a typical case with large banking corporations. We take that small business approach where, you know, we want to be available, we want to be a resource to you, and we want to help you build your business. I ask my loan officers to go and sit down with the real estate agents and ask them their goals and their business goals at the end of the year, right? Because at the end of the day, it's not just about us coming in and asking for leads, asking for business, asking you to help us grow our business. It's not about that. It has to be reciprocal, and it has to be a relationship that that we're looking to build on a long-term basis, and the loyalty and the support has to be there from the ground up. So we fully understand that you're coming into this new business, new career, and we want to help you develop it. But in order for us to do that, we have to help you build that foundation as strong as possible. And we do it by giving you, again, you know, resources, material, answers, webinars, whatever you name it, open houses. We want to be there to help you build your business stronger. We want to help you market, you know, target the first-time home buyers, the down payment assistance, you name it, right? We do every other loan program that's out there these days. So, you know, try to build that bond, try to build that team, and hopefully we can earn an opportunity to build that relationship with you guys. So at the end of the day, again, if it's not us, if it's not a mortgage pro loan officer, you know, reach out to at least one loan officer that you have you place your trust in. So that's probably the most important piece of advice that I can give a new real estate agent.
Thank you, Oz. Well, that's all I have for you guys. I thank you for your time. Go ahead.
I did want to mention, we are bilingual. I think somebody had asked that question. Most of us speak Spanish, and we're able to talk to your clients in Spanish as well, if you have any questions.
The other thing, if I could, you mentioned you have an office in Mission and one in McAllen, but you can handle loans anywhere, correct? Because you have that capability.
Correct. Yes. Anywhere in the state of Texas.
Exactly. And if they're using that app, that even makes it easier to make things work for you, correct?
Definitely.
Good,
Yes.
good to go. Good to go. One of the best things I loved is the fact that you threw in there that you guys use common sense. Love that. You don't see that too often today. Absolutely. Good. Anybody have anything else for him? All right. Well, Oz, Brittany, I appreciate you guys. It's fantastic.
Thank you.
Thank
Have the
you.
morning.
Thank you.
Yeah,
for your
thank you for having us, Mac.
Yes, ma'am. You guys have a great day.
You too.
Thanks.
Thank you.
Bye-bye.
Thank you.
Thank you.